In this lecture, we are going to study how we can approach the market in order to determine its trend. As it is usually mentioned, determining the trend of a market is quite useful because trading with the flow of the overall trend is a lot easier than trading against it. To begin understanding how to read the markets and the proper way to establish the trend, we need to grasp the concept of market structure. The market structure is composed of undeniable facts that a trader can read on a price chart. These facts relate to relationship between buyers and sellers in the market. The fundamental unit of measure of market structure are the market vectors. In other words, the vector between a high and a low or a low and a high. When we look at the charts, we can observe a series of market vectors and determine that they form patterns. For example, when price makes higher highs and higher lows, we observe the market vectors stair-stepping up. If we look at this idea more closely, we can see the logic behind this intuition of uptrend that comes from higher highs and higher lows, and also the intuition of a downtrend that comes from lower highs and lower lows. We can view the highs as the ultimate attempt of buyers to drive the market up, and the lows as the ultimate attempt of sellers to bring the market down. In an uptrend, the buyers are stronger than sellers, so they can produce higher highs. In a downtrend, the sellers are stronger than the buyers, so they can produce lower lows. That's an incredibly simple idea, but that's the fundamental nature of how price behaves on a chart. However, as you are about to find out, simple does not necessarily mean easy because of the fractal nature of the markets and the inherent level of complexity attached to the chain of causality of price. This complexity begins to show its face when we first recognize that there are multiple types of players in the market. In other words, there are traders with different amounts of capital power looking at the charts in different timeframes. This variation is what makes the simple mechanism of buyers and sellers complicated to observe sometimes. The problem is that we can usually see different herds of market players in the same chart. This brings us back to the notion of the flows in the market. In one single timeframe, we usually can observe at least a major market flow and a minor market flow. This touches in one of the hardest problems of trading, which is identifying where these flows shift and the hierarchy of power between them. Remembering that fractal means pattern that repeats inside itself, we can try to identify different market flows in the same timeframe. This is where the principle of subjective interpretation of market comes into play. Two different traders counting major and minor highs and lows on a chart might arrive at different conclusions about which highs and lows belong to the major flow and which highs and lows belong to the minor flow. It's important to notice also that there is a hierarchy of power between the major flow and the minor flow of the market. This relationship is mediated by what we call market memory, which is how much past information the current market remembers and respects. This is relative to the timeframe under analysis, of course. That's a tricky part of analyzing market flows because sometimes the minor flow will have more power than the major flow, and that is due to the interference of market memory. This is a situation that many traders have experienced in one way or the other. For example, imagine that you build a context for your trade idea by looking at the most obvious highs and lows on the chart, which usually come from the major flow. When price finally arrives at the place you were expecting it to have one type of reaction, you get caught by surprise because the market is the exact opposite of what you predicted. The reasons for this is the lack of attention in the minor flow and the failure to understand that the highs and lows you have used to form your context are not part of market memory anymore, so the minor flow seems to win over the major flow. Once again, understanding this subtle flow-shifting nature of the markets is one of the most challenging aspects of trading, and it is also a critical one. The identification of a flow shift in the market depends on several contextual factors, so the better you are at building trading contexts and reading the market organically, the better you are going to be at identifying these subtle flow changes. Another critical aspect of market structure is the notion of confirmed market structures and fake market structures, which recognition depend entirely on the candlestick reading of the highs and lows. This is also paramount to understand because most of the times, we will use only confirmed market structure to place our stop-loss orders. The logic behind that is quite simple. A confirmed market structure, as it was alluded in the beginning, is an undeniable fact in the charts. For example, a low is only confirmed when price surpasses the last high. By the same token, a high is only confirmed market structure when price surpasses the last low. That's fine, but there is a very important catch here that adds another layer of complexity to this story. Sometimes, price surpasses the last high or low, but it doesn't close above or below it. In other words, price only pierces the level in which a market structure would be confirmed. This is often the work of market makers who are attempting to employ their manipulative maneuvers on unadvised retail traders, which is a deeper subject that is outside the scope of this lecture, and it will probably be explored in another video course. That brings us to the notion of fake market structures, which is when price only pierces the level that is supposed to confirm the last high or low. As the name suggests, we cannot rely on these types of structures as a solid place to put a stop-loss order because most of the times, these fake structures are made to be broken, so putting a stop-loss near them is a bad idea. By now you must be able to recognize that the simple mechanism of highs and lows in the market creates a few challenges that are not so simple. We need to pay attention to the different flows of the market and the points where they collide. We need to make the correct judgments about the hierarchy between the major and minor flows, and we need to classify the highs and lows of the market between confirmed and fake market structures. Keep in mind that in this lecture, we are only exploring the conceptual part of what we should be paying attention to in a chart. It's difficult to condense all the nuances of the practical application of these ideas into their purest forms because the markets have many different scenarios, and these ideas happen in many different ways. Once again, the best way to study these things is by observing the way they happen in real charts, which is what we will do in the lectures that contain trading examples.